Okay, I think we'll get going here. More people are coming in, lots of people on the call, so we appreciate your time today. My name is Graham Roberts. I'm your wholesaler, VP of Regional Sales with NCM Investments, covering the GTA region. Thank you very much for coming on the call today. Just a little bit of housekeeping here before we get going. We are in Zoom presentation mode, and that means that your cameras are off and your microphones are muted. So we encourage you to use the Q&A link button at the bottom there if you do have any questions, or you can follow up afterwards. We're always available. So thanks for that. And it is being recorded, so you will get a follow-up of this. So you don't have to take copious amounts of notes unless you want to, but you will have a link to a follow-up. And again, wholesalers can always answer all your questions, and the PMs can too also. Okay, so NCM Investments has been helping advisors strengthen their book of business for over 20 years. And I have two individuals who were part of that strengthening, help advisors strengthen their book of business with me today. Alex Sasso, who a lot of you know, been around for a long time in the business and been with NCM for a very long time, is lead PM and on our high quality Canadian all cap dividend fund, the NCM Income Growth Fund. He's been on the fund since inception over 15 years ago. And the strong long and short-term performance speaks to his capabilities. Again, we're not going to talk performance and everything right now, but that information will come to you in a follow-up. But you just believe me that it is very strong from start to finish. Hi, Alex. Welcome.
Hey.
Okay, Jason Isaac is lead PM on our 10-year-old global all-cap dividend fund, mainly large and mega cap, named the NCM Global Income Growth Fund. Jason has been helping manage the fund for over 3 years with a very long track record in the business before that, and took over lead PM duties from Craig Miller over a year ago. And the short and long-term performance of the Global Income Growth Fund speak to both Craig and Jason's capabilities. So Jason, welcome, thank you.
All right, thanks.
Okay, so both funds pay out a roughly 4% tax efficient distribution to your end clients. That's annualized but paid monthly, and it's tax efficient through a corporate class structure. And also note that both funds do have a little bit of fixed income in their mandates, roughly 10 to 20%, but you can think of both solutions as high quality dividend investing, be it in Canada in the all cap space with Alex, or with Jason on the global side, again, more the large and mega cap. And I'll let them talk to that. Okay, I'm done here. I'm going to ask a question to each of you, and then a second question and a third that I have. And we had a few questions come in from our advisor community, so thank you very much. And we've incorporated your questions into the answers that the two gentlemen will talk to. So, Alex, question number one: what do you look for when picking stocks and bonds for your fund, the Income Growth Fund?
Good intro, Graham. So just on the fixed income side of the portfolio, it's usually around 10%. We tend to hug that 10% fixed income guidepost. And really what we try doing there is generate a yield and not lose money. So we have a team that does that. So that is outside of my capabilities, although I do oversee it and I do approve all of those fixed income investments. On the equity side, which is more of what I do on a day-to-day basis, we're looking for companies that meet both our quantitative and fundamental criteria. The combination of the two, Graham, really produces businesses that have a history of cash flow and earnings growth. That's really what's important to us. Valuation is a very big focus of ours. Many of our companies we feel are underappreciated by the market and trade at significant discounts to their intrinsic values. We tend to be blue collar in that we roll up our sleeves. We find our own ideas. We develop our own models. I find that when we create our own models, it really gives you an appreciation for the business, the leverage in the business. So many businesses out there you invest in, and then you find that they hit your revenue growth targets, but there's no leverage in the business model. So when you do your own modeling, you figure out very quickly which businesses have leverage in their business model, what they've done in past cycles, and whether or not some of the management projections for future growth are believable. So I say that, you know, it's blue collar in that a lot of the street today tends to outsource some of that work to the analyst community. I would say that we use both the analysts on the street that have specialty in certain mandates, certain industries, but we tend to do a lot of the homework ourselves. When a company meets our quantitative valuation parameters, and by that I mean, like, we're looking for growth rates both on the top line, EBITDA and earnings line. We're looking for high return on equities. We're looking for clean balance sheets, and clean balance sheets are so critical because what I will show, I have a slide later, I will show it's really the dividend growers that you want to capture in these mandates. Dividend growers tend to outperform over time. And then once we get comfortable with the quants, we really do the fundamental homework, and the fundamental homework is key because we're asking ourselves the question, does that strategy make sense and is believable as we look at this business 3 to 5 years out? So, we do the 1 year out homework, we take a look at the trailing numbers, but 3 to 5 years, are those numbers believable based on the products that they have today, based on the products that they have in the pipeline, based on their customer set, based on the growth in the industry? And that's what we're asking ourselves. Does management have discipline in and around costs and cost cutting? Does management have skin in the game? That's really key to us. And how is management incentivized? I've seen so many businesses where management's incentivized by absolute revenue growth or absolute earnings growth. But what's really more important to us is a per share revenue growth number or a per share earnings growth numbers. Those are really key for us. And then, of course, you want management that has skin in the game, because if they have skin in the game, issuing equity becomes something they do only when they have a material growth driver in their business. And then I think the way I'll finish off by answering your question is I'll just highlight some of the attributes inherent in the income growth fund. These are derived by Bloomberg, and they're as of last week, but I think it will show the audience how we pick stocks. So this is the equity portion of the portfolio. Font here is a little bit small, so bear with me, but if we look at the 2019 over 2018 revenue growth, so pre-COVID, where the median companies growing their revenues at 10% per year. Okay, it's 1 year revenue growth number, it's pre-COVID. During COVID, we had 3% revenue growth. So 2020 over 2019, which to me is a very impressive number given what happened last year in a diversified portfolio. All right, now let's look at 21 over 20. Again, single year, but we've got 17% expected revenue growth this year. So significant jump, as we've seen with many companies, and as we've seen in Q4 and Q1 earnings numbers, the revenue growth numbers for the market has been very strong, but specifically with this fund, been strong. Okay, so those are 1 year numbers. Let's talk 5 year numbers. So if we look at the 5 year number, we're talking 10% revenue growth. Again, we talked about operating leverage in a business. Let's see what these guys are generating on a Ebitda growth metric. So again, pre-COVID, 2019 over 2018, we've got 21% weighted average earnings growth. 2020 over 2019, so during COVID, these companies grew at 16%. Okay, this is the weighted average of the entire portfolio. And then as we look at 21 over 20, we got 27% earnings growth. So really, really strong growth attributes in these businesses. And yet what I'm really proud of is we're not paying for this growth. And the reason I say we're not paying for this growth is because this portfolio is trading at 8.2 times enterprise value to EBITDA. So a substantial discount to the market. So you're getting better revenue growth and you're paying a substantial discount in price. If we look at price earnings, 14.9 times current year price earnings number, and our price to cash flow is sub 9 times. Our return on equity is 16%. Again, return on equity, very important for us. And our free cash flow yield, again, if you want to invest in a bunch of dividend growers, which have been shown to outperform over time, you want a strong free cash flow generating business. And we've got a 9.3 weighted average percentage free cash flow yield in the portfolio, with a 2.1 times debt to EBITDA ratio. So clean balance sheets, strong free cash flow, strong revenue growth, strong earnings growth.
Okay, I love it. And for the audience, if you were quick enough to write all that down, that's amazing. But you will get this information one way or another from your wholesalers, be it talking about the stocks or the specific criteria numbers that Alex just laid out. We can get that to you, but very strong. Thank you, Alex. Okay, first question over to Jason. What do you look for when you're putting together the Global Income Growth Fund? Thanks.
Alex just stole all my thunder, actually. He just went through. The process is exactly the same, other than the fact that we look at the global market as the opportunity set. We're not just, I would say, handcuffed to Canada, but keep in mind global as an opportunity set, that there are Canadian companies that are worthy of inclusion in this. It's just, we do have the ability to go outside. So typically on the equity side, focused on dividend growers there, but I also sprinkle in a barbell approach with that. There's going to be a strong dividend growth profile for a lot of the companies, but there's also going to be disruptors and innovators sprinkled in there. And that's going to be for the growth. And what I say about from the Canadian perspective, Canada does materials, Canada does financials, Canada does utilities arguably, and telecoms really, really well. They don't do healthcare really well, other than, pot. And, I don't know if that's a well-diversified section of the area you can go. Technology is not the same. So we need to go outside, and so we look at it as an opportunity set. And one of the things that I know Alex didn't mention, but it's very, very high on his list, and it's definitely everything we do at the NCM here, is we really have a high active share, which means we've got equities in the portfolio that aren't representative of what you're just going to do in an index. We've got names that have those growth metrics, that free cash flow metrics, and hold them at weights that are different than what you just do if you're throwing a dart at a dartboard for an index. On the fixed income side, the portfolio has been a little bit re-engineered. We've moved away from a large weighting on high yield, and we've gone more to using the fixed income side as ballast. Again, with Alex, we've got a team here that helps me in the fixed income side. I still have final say over all of that, but at the end of the day, the fixed income is used for ballast and monitoring the risk of the overall portfolio. So I ultimately, to sum it up without getting into the metrics and recognizing we don't want to get long in the tooth in this, is it's a fully invested global equity balanced strategy utilizing broad geographic and sector diversification.
Perfect. Love it. Thank you. I'm going to ask actually a question from the audience today, and it's just around overlap. I don't think there's much of any overlap in these mandates, definitely on the equity side, and even on the fixed income side, there might be a bit, but hardly any. Just talking the fact that they are truly unique from each other too.
Alex, you want to go first? Yeah.
Yeah, no, absolutely. Yeah, they're definitely very different. There may be small overlap on the fixed income side, but certainly on the equity side, there's very little, if any, overlap.
Yeah, just for perspective, if we were to look at a lot of the large world cap markets, Canada represents about 3%. So an aggressive global equity fund that has a large weight to Canada is typically unheard of. The income with growth is a Canadian equity portfolio. This right now running about 11% in Canada, and those names are not necessarily what Alex is looking for in his income and growth. So there's very, very little overlap. They actually complement each other very well.
Perfect. Great answer. Thank you. Okay, so I'll go back to Alex for question 2, and just how you set up the income growth fund based on what's happening right now and kind of where you can see out in terms of from a market and economic perspective.
So thanks, Graham. And we've definitely positioned the fund so that in a normal cycle, I emphasize normal, that we should have a strong shot at a meaningful rate of return and certainly outperforming our peers. And if we try to outperform our peers, we'll generate a meaningful rate of return in most years. The two kind of go hand in hand. So then the question really becomes, how does one do that? And what are the driving factors behind outperformance? So we talked earlier, dividends outperform over time. Maybe if we could throw up chart 4, please. So, it's important to have exposure to a portfolio of dividend paying stocks because essentially over time they produce higher rates of return and annual rates of return. And those rates of return are compounding rates of return. So take a look at this data compiled by BMO, CompuStat, and IBIS. So between 1990 and today, dividend payers have returned a CAGR, and CAGR stands for compound annual growth rate of 9.8% per year. That means you're getting in year one, 9.8%, in year two, 9.8%, in year three, 9.8% over that time period, significantly better than what a GIC will pay you or most fixed income products will pay you, and generating a meaningful real rate of return versus the TSX of 7.9. And look at the middle bar there. So the middle bar will show you that they've generated just 0.7% rate of return. So those are the non-dividend payers. So if you're invested in Canada, non-dividend paying companies, you have to have a lot of conviction because you have a significant amount of headwind. And historically speaking, at least, you've significantly underperformed. So owning dividend paying companies is a key critical component of, one of those outperformance drivers. Another outperformance driver, Graham, is you want to own, within the dividend category, you want to own the growers versus the payers. Now, the payers will still generate a good rate of return for you and will outperform the TSX, but the growers, please put up chart number 1, but the growers have outperformed the payers. And with income growth and global income growth, this is what we really focus in on, are those growers. I mentioned in the past that we focus in on companies that have a 50% payout ratio, and the importance of a 50% payout ratio. So the payout ratio is of $1 of cash flow, free cash flow that comes into the business. What do we do? What's the capital allocation policy? So with these companies, on average, 50% gets invested back into the business and 50% gets paid out in the form of a dividend. We like these companies that take that 50% and invest it back in the business because it enables them to invest in the future of the business, whether it be a greenfield plant, whether it be an acquisition, or whether it be some sort of capital allocation exercise that adds value to the owners of the business is important. So if we look at this chart here, which was produced by RBC, it's data between 1986 and 2020. And what they did is categorized a bunch of businesses into different categories. And if you take a look at the right-hand side of this chart, you've got those companies that don't pay a dividend. So we talked about the chart that we saw earlier where they generated a 0.7% rate of return. It was a different time period, but here you can see the non-payers, similar rate of return at 1.2%. The dividend cutters actually outperformed the non-payers. The dividend cutters generated a 2.9% rate of return, the TSX at 6%, and then you can see the dividend payers at 9.3%, but a meaningful improvement is the dividend growers at 10.9%. And if you want to go to chart number 2, please. What is really impressive is the standard deviation of those better rates of return. So I'll take you this time to the left-hand side, and you can see the dividend growers has a standard deviation of 13.3%. So you get a better rate of return and you get less volatility with the dividend growers. If you go to the far right, you can see the dividend cutters. You get a lower rate of return and you get much more volatility in the stocks. So that's kind of that. Those two charts, in my opinion, say a lot. Another chart that I think says a lot is chart number 3. If we could put up chart number 3. What we're showing in chart number 3 is that dividends have fairly consistently and fairly significantly contributed to total returns year after year. And it's coming up now. So you can see over time the meaningful improvement in the returns, including reinvested dividends versus the returns that don't include invested dividends. So this is research from Morningstar. And as you know, I'm a meaningful believer. I'm a believer that dividends make up a meaningful percentage, should make up a meaningful percentage of a client's portfolios. And I think if you did those things, focused on dividends, focused on dividend growers, embedded some high active share in your portfolio, meaning that you pick an investment product that doesn't look like the index, that has an opportunity to look different than the index. They have an opportunity to outperform. If you pick an investment product with low active share, they are engineered to underperform. You want to like the investment methodology of the management team. I'm a big believer in ours, but whether you don't like ours, you still want to follow some of these rules on picking a product that has an opportunity to outperform. And then the last thing I will say is, don't always think of the product on a before tax basis. Think of the product on an after tax basis as well. So Graham had mentioned early at the outset that these products have tax advantage features. Income growth pays out eligible dividends, which are taxed favorably, but we also use the expenses of the corporation, because these are corporate class funds. We use the expenses of the corporation to offset some of the interest income that we're generating off the fixed income portion of the portfolios.
Okay, so a few more questions coming in here, but I'm going to send this over to Jason to answer question 2, and then we'll probably, for the audience, to say cut down question 3, maybe just to the guys talking about one stock, but over to Jason and how you set up the global income growth based on what's happening in the economy and the market right now, and where you, how far out you can look. Thank you.
Perfect. Okay, so my initial answer, again, I'm preaching from the same choir that Alex is with regards to dividends. So take all that information that Alex put, and it's exactly the same in the global market. So that rationale is why that's where you want to be, is exactly where you want to be. I'm going to go down one level and just kind of sift through the little bit of the weeds. And when it comes to setting it up, one of the things that we're going to do with the global income growth is probably we're going to be a little bit more active with the asset mix call. Right now, we're heavyweight equities. One of the things I look at, I'm not a technician by any stretch of the imagination, but I do look at what the market's telling us. And right now, basically for the last 6 months, definitely leading up to the US election, cyclicals, basic cyclical sectors were outperforming defensive sectors. We had credit was still in good shape. We had industrial metals outperforming precious metals, and consumer finance was taking off. These are all things that don't happen late cycle. They're all stuff mid-cycle, which tells you want to be overweight equities. Now, we can also take a step back and go, well, look at the high-level environment that we're at. Would you rather be in a high-yield fixed income asset, or would you rather be in a good quality equity asset if you're going to experience, and Alex talked about it, the same risk parameters? Well, you'd rather be in the equity because you have that more upside. So there is a lot of effort and tailwinds just being in equities. So when it comes to looking at the portfolio, overweight material sectors, overweight energy to a certain extent, relative to what we need to be. Like, by no means is it like 40 or 50%, but we're overweight. We're going on the sectors that are running, and we're making sure that things aren't running too hot. And then when things start running hot and we get to that late cycle, you're going to see a scale back in the risk. One of the things that you'll see in the portfolio is I will trim those innovators and disruptors a little bit, because those are the ones that are going to be really, really volatile. They're the long duration assets. They don't have that dividend payback that helps dampen the volatility. I will slide that over to the more stable names. And that's going to be an overall sector allocation. You're going to see that. You're going to see people taking money from technology and going to healthcare. You're going to see people taking money from discretionary and going to staples. The fact is, as much as everybody's looking at, well, we've had a little bit of a setback and all that sort of stuff, and everybody's talking about inflation, and I know that's going to be a question, so I'll kind of cue that up for down the road, but this is just part of the process. We're not actually seeing that in the market. We're seeing, consumer discretionary, financials, industrials. These are all areas of the market that are still performing extremely well. So that is the posture that the portfolio has. So I'm hopeful that answers your question on a different level.
Yeah, that's great. Yeah, I think I'll maybe get to inflation in your next question here. So thanks for that on how you've set up the funds based on what's happening out there in the markets and the economy. We'll probably keep the third question just to one stock that you own, because there's one or two questions we might be able to get to after that from the audience again. So back to you, Alex, for question 3. Just one name. in the income growth that you like as part of a basket of 30 or 40 names. I'm sure you like it on its own, but I know you buy it and set up the entire portfolio, including the other names, as a basket of call it 30 stocks. So one idea is great, and we'll leave the second one alone so we can let Jason answer that question too.
Yeah, great. And so, yeah, we've got 27 equity names in the fund right now. Our top 10 make up just shy of 50%, which is ideally where we want to be. It's probably a little bit light on the number of names relative to historical, but in terms of speaking on an individual name, maybe I'll talk about K-Bro Linen. So let me back up. K-Bro Linen, what do they do? So they're a leader in Canada and the UK at doing something that is not very complicated. They provide linen services to the healthcare and hospitality industry. I love the business because it's a recurring revenue business. These are very long-term contracts, and it's a recurring revenue business that doesn't get the recurring revenue multiple that we see in so many other industries. They're taking market share. They're very vertically integrated, and I love that they're vertically integrated because what that means is they have greater control of their costs. They tend to be a low-cost provider. And one of the other reasons why I like this business, and this is going to sound strange to the audience, but just give me a second to explain it. They are a COVID winner and they are a COVID loser. So I say they're a COVID winner because some of the linens service the hospital or healthcare industry. And as everybody can imagine, those ICUs have been a lot busier than normal, and so you need linen services in order to make sure that those patients have clean linens every day. So that business has been doing really well. What's been hurting the business, and why I say it was partially a COVID loser, is because they also service the hospitality industry. So all those restaurants that are closed down. But to me, that is the opportunity, because on the hospital side of the business, that may shrink a little bit as we go into 21 and 22 and as we pass through this health pandemic, but it will do so marginally, where we'll get a very big ramp on the hospitality side of the business. And I thought one of the best ways to show the business was to take a look at some of the key metrics provided to us from Mcm Capital post their latest quarter. It was as of April 21. So just I'll highlight a couple rows here. So take a look at the revenue line, the very top revenue row. You can see revenues of 46.3 in Q1 and 53, and you can see how that is ramping. Now take a look at the adjusted Ebitda line. And the net earnings line. So we're starting to see free cash flow develop into the business, and we're starting to see that operating leverage that's so important to us. So if we're investing in these revenue growers, we want to see operating leverage. We want to see that fall to the bottom line. We don't want them to take all that money, reinvest in sales and marketing, and kill that operating leverage, because as we mentioned earlier, the dividend growers are the ones that are going to outperform. If you've got operating leverage and you're generating lots of free cash flow, what that means is that management's got some capital allocation decisions to make. Do they make an additional acquisitions because this company's been acquisitive? Do they invest in a greenfield plant? Or do they pay that out to shareholders in the form of higher dividends and or stock buybacks? So now take a look at the annual numbers. So you see the revenue growth just below the grayish bar. The revenue growth on an annual basis of 252.4 in 2019. And we don't expect them to return to those numbers again until 2022. But take a look at the EBITDA margin percentage. It's a big improvement. And this is why we like this company, because we think with that kind of leverage, we're going to see earnings double over that time period to 20.5. And the enterprise value to EBITDA of this business is only 10 times. And you also take a look at the net debt to EBITDA number as you go out to 2022. I know it's hard to follow me here, but take a look at the net debt, the second last row to EBITDA number, and you see effectively a clean balance sheet with a business that's generating a ton of free cash flow. Again, these are all positive metrics, and what it means is we're likely to see dividend increases in this business over the next couple of years.
Okay, that's great. Yeah, you're looking for those type of attributes across all of your stocks. So thanks for that example. And we have more examples from Alex if need be through an email or a call, always available to talk stocks that might be of interest, but to reach out to your wholesaler if you want to do that. So I'll pass it over to Jason. And again, just one idea in the Global Income Growth Fund that stands out as being unique and why you like it.
The one that I've picked kind of encapsulates what this fund is all about. Slide 13 there, Mitch, is DSV. It's a logistics and transportation company based out of Europe. And it provides cargo and distribution services, as well as value-added services right across the spectrum of moving product. So, think of it as like a FedEx or a UPS, but instead of taking something from, Minneapolis to California, you're taking, computer chips from Belgium and sending them to Poland. So, and, you're dealing across multiple jurisdictions, and in some cases different currencies. Not everybody in Europe is on the euro and things like that. So, warehousing, customs, purchase order management, and it's just a best in class freight forwarder. The thing that they specialize in chemicals, areas of chemicals. We know with the COVID and the healthcare space, they moving chemicals in safe and secure environments, and anything with healthcare and PPE and stuff like that. Perishables, oil and gas, and technology. Those tends to be the areas that they specialize in. But they also provide customs clearance services, which really helps somebody to move something from London to Italy. It's a one-shop stop, and this slide just kind of details exactly. A client can pick up something that CVS is doing, and they can take care of absolutely every aspect of the movement chain for your product, start to finish. But the real thing that they're really adding is that 4PL service on the bottom, which is data analytics and logistics. And that's a key theme that I've got in the portfolio. There's a couple other names that I'm happy to talk about on a different call. But what they're really supplying, and this is where they're going to be able to monetize in the same way a lot of these subscription services and data services, they're going to be able to turn around and go back to their client and say, you've got 4 different warehouses in continental Europe, and you're all sending this within 3 days of each other. Why don't you start to amalgamate that, send it to one place, and you've got this purchasing manager making this purchasing decision when, not even talking to this guy, and they're going to be able to help their own clients do internal diagnostics on where data is and slippages and cost overruns and things like that. This is the best in class. And what it really highlights is what Alex was talking about with K-Bro there. You got we've modeled it out, and I've got about a 5% revenue growth on this portfolio, on this particular stock for the next 5 years, which doesn't sound great, but it's better than GDP growth. But their earnings are supposed to grow at 10.8% over that 5, which means margins are expanding, and their free cash flow is growing at 13%, and their dividend growth is growing at 14% per year over the next 5 years. Nothing but good things can happen to shareholders when you've got companies that are kicking out metrics like that. That's all there is to it. So that's the one that really encapsulates. And it's been a long-term holding.
Yeah, I know that's a throwback to Craig Miller, and I know you like a lot. You worked with him, and like a lot of the ideas that he had in the fund, he helps him set it up.
I'm a big fan of not reinventing the wheel. If it's working, let her roll.
Okay, well, I know there's a bunch of names in the Global Income Growth that you both liked and both bought, and I know there's also some names that you put in since then, and that can be talked at another point. But it's definitely a combination of Craig and Jason, the best of both, with Jason now leading the fund, and Craig's doing great for all those who might be asking, by the way. So there's a bunch more questions. We're at 1:34. I'm just gonna maybe talk to one of them, ask one of them quickly, and we will get those answered to the rest, but we don't want to take up another half an hour. So what is a typical hold period and typical portfolio turnover? If you can just answer that, Alex, very quickly, and maybe Jason very quickly.
Yeah, I'll be super quick. So the typical hold period is 3 years, and our turnover rate is about 30%. So we tend not to be stock jockeys. It's really hard for us to find a company that qualifies both quantitatively and fundamentally. So when we do find it, we tend to take bigger weights and get to know the management teams fairly well.
I know on the global side, I would echo that. I'd never typically make a purchase of a stock without the idea that I'm going to be there for a minimum of 3 years. Of course, things change. That's why you have to have managers and, you know, companies buy stuff out, but it's usually 3 years or longer, a full market cycle. The turnover was a little bit higher than it normally was, but I anticipate it's going to be sub 20% on this portfolio. I'm hoping to get it below 15. After it's all said and done, but if there's an asset mix switch, that'll change it. But generally, around 20% is what I would look to have the turnover period.
Okay, perfect. Thanks, guys, and thank you everyone who came on the call today. Again, a couple of questions, and we have noted those, and we will get back to you with those answers. And always lots of Q&A available again with Alex and Jason going forward on a one-off basis if that is what you want. So thanks for your time. We hope you guys have gained some insight and some trust around what Alex is doing with the NCM Income Growth Fund and Jason is doing with the NCM Global Income Growth Fund. We believe it can help strengthen your business as a complement to what you're already running. And we'd like to provide more information on that and why that's the case through one-on-ones with the wholesalers. Again, a replay is going to be available here for you and a follow-up email. So look for that with notes on what's happening in the funds. And please reach out to your wholesaler, or you can email sales@ncminvestments.com if you need further information. Again, thank you so much, everybody. Alex, Jason, thank you.
Thanks.
Thanks for inviting me.
Okay, always. And everyone have a great day, and thanks again. Take care.
Peace.